At the end of the day, it's all about you and your needs, because at Haven, we are a safe place for people to seek advice without the fear of oversold, missold, and oversold.
Welcome to today's episode of 10 must-know insurance tips agents may not tell you. I'm Jayla, experience specialist, and this is Eddy, Haven CEO.
Hi.
And our favorite insurance expert. At Haven, we believe that insurance advice should be clear, not confusing, and always aligned with your needs. I'll ask every question that you've always wanted to ask, and Eddy will answer them. As a layman, I'll promise I'll keep asking until I get it. I hope this helps you make clear insurance decisions without overpaying for coverage. Let's dive into today's topic. So today's topic will be, is it possible to not invest at all and still lead a comfortable retirement? So the first question I have for you, Eddy, is I keep hearing this very popular phrase of buy term and invest the rest. What does it actually mean?
All right. Buy term, invest the rest is a common insurance concept. Basically, it means that if you buy the low-cost term plans, it is better than getting an expensive whole life plans, because the cost savings by getting a term plans, if you invest it, you get better cash value than what you can get from a whole life plans.
Okay.
At Haven, we are strong proponents of term policies from insurance, but that's not because we believe in buy term, invest the rest. It's because we believe that to be sufficiently covered, most people do not have a lot of resources, and term plan is the only way to allow them to be fully covered. If you buy whole life plans to be fully covered, firstly, it's very expensive. It's not possible to get covered, and as a result, most people are underinsured.
So does it mean that everybody has to invest in order to retire?
Not necessary. I mean, we have seen a lot of cases whereby people retired without dabbling into investments or without depending on investments. There are people we may know, all right? So, but whether a person should invest or not, it depends on a few things. Firstly, it depends on whether is there a need to invest, and secondly, is there a willingness, risk appetite to invest. So when we talk about the need to invest, it's a question about how big is your retirement goal versus what you have right now. Okay, if the gap is huge, then you probably need to do a few things. Firstly, you need to save more, manage your finances, save more, and invest and put into your retirement assets. Or secondly, making sure that your retirement assets is growing better than putting money in the bank. Okay, so or you can also invest it. Okay, however, when you talk about investments, it also depends on whether the person is willing or able to take the investment risk, because not everybody is suitable to invest. If a person is conservative, okay, in terms of risk appetite, and he goes into investment, it could be worse off, because in the market downturn, the person may choose to cash out at the wrong time, and it is better that he or she doesn't invest at all. So it really depends. So whether is there a need to invest, it really depends on your goal and also your investment appetite, whether it is suitable for it. Since we're talking about retirement, actually there are three must-have when it comes to retirement. Firstly, you need to have a house fully paid. That's actually your physical needs. Second is to have a stream of income for your retirement, and that is your financial needs.
Okay.
And thirdly, which is your medical safety net. That is your medical or healthcare needs.
By retirement age, most Singaporeans will have their HDB fully paid. And what if I'm someone that I'm super afraid of investing, especially with the market volatility now? How can I ensure a secure retirement by not investing?
For most people, they can secure their retirement without investing by focusing on three areas that is critical in retirement. At Haven, we call this the 3 C's: CPF management, cash flow, as well as coverage.
So you mentioned coverage. So what coverage means, like your insurance?
Yes, coverage refers to the medical safety nets, which is the insurance protection.
Okay.
Yeah.
So, as for medical insurance, as I grow older, the medical cost will be higher, right? So can I just know, how does Haven address this for retirement needs?
Insurance needs actually evolve over time, from working years to retirement years. Okay, what's important in your working years may not be as important in your retirement years. But in retirement, there are actually two important medical protections that you should have. First is your hospitalization plan. This is your MediShield Life and your Integration plan. This will provide coverage in the event that the person needs to be treated in hospital or surgery, example for cataract as well as cancer treatment. The second is actually long-term care. This is your CashFlow Life or ElderShield coverage. This will, as we grow old, there's a higher chance of suffering severe disability, such as dementia or suffering accident or having a stroke that a person is not able to function independently and therefore needs not a caregiver. All right. So long-term care actually provides that coverage.
Okay.
So the good news is that some of these premiums can be paid by your CPF, your MA account, which is your MediSave account. All right. But the bad news is that because for some of the plans like your integration plans, if you have it, okay, the premiums actually goes up over time, and when a person is 50, 60 plus onwards, it's expensive. It becomes more and more expensive. The bad news is that for some people, especially when their MediSave account is not huge enough, all right, there could be a risk whereby at some point it's not enough to pay for this medical insurance, especially if, let's say, you're paying not just for yourself, you pay for your family members, the spouse and the children, it will deplete very fast. Okay. So the thing about having this safety net is to ensure that you have enough CPF MediSave account to pay for it. And if not, you need to set aside extra money to fund these medical premiums so that your medical safety net is secure in your retirement.
Okay. So now that we have house settled, medical insurance settled, and you mentioned about CPF earlier. So how does CPF come into play for retirement?
Okay, CPF actually is a very important piece when it comes to retirement. Okay, I mean, in Singapore, everybody have a CPF account. Okay, and CPF account actually gives you very good interest rates of 4% and above. All right, and it's risk-free, meaning that you don't have to invest to get the return, and therefore you need to really leverage it well for your retirement. Okay. Even though CPF is a very important piece in your retirement, actually there are a lot of rules and it's actually make it very difficult to navigate, to understand how CPF can work for you, optimized for you. All right, but actually the way to think about it is that you can think of CPF as having two phases. The first phase is what you call a building phase, and it's up to 65 years old. And then the second phase beyond 65 is called the spending phase. Okay, in the building phase, the objective of CPF is basically to build up your special account as much as possible to the maximum. All right. So during the building phase, the objective is basically to max out your special account as early as possible.
Okay.
All right.
Max out.
Yeah, max out, basically to reach the maximum limit possible for you, which is called the full retirement sum, or FRS.
Okay.
FRS, yes. So you can do that by a few ways, such as doing a top up to increase into your special accounts, or you can do a transfer from your original account OA to your special account SA. Okay. So when at 55 years old, age 55, there is a very important milestone. This is where your special account is closed, and then the amount in your OA and SA will be transferred to your RA account. Okay. And you can determine how much you want to transfer over to RA. So there are three options you can consider. One is the BRS, which is the basic retirement sum, or FRS, the full retirement sum, and the ERS,
enhanced retirement sum.
So just an illustration, if a person is currently 55 years old, all right, the FRS amount for that person is $213,000.
$213,000. Okay.
So if you choose the FRS, $213,000 will goes into RA account. At age 65, all right, it will generate a CPF life income of about $1,300 to about $1,700. Depends on
month.
Per month. Depends on the plans that the person choose. Okay. So that is your building phase. Okay. At 65, this is your spending phase. In this spending phase, before the CPF life is being triggered, you can choose three types of plans from this CPF. Like there are three options. It could be you can choose the basic CPF life plan, or standard plan, or the escalating plan. Okay. As a default, you will be opted into the standard plan.
Okay.
Okay, so as a standard plan, as I mentioned just now, you get about 1,007. Example. Okay, my example, 1,007 per month for rest of your life, right?
Okay.
But of course, if you choose the basic plan, basically it means that the amount will be lesser. Okay, but the benefit is that if death occurs early on, okay, there will be higher bequest. That means the unused capital will pass on to your beneficiaries. Or if you choose the escalating plan, the amount will be even lesser. So in my example, it's $1,300. All right. But every year, because you will catch up with inflation. I mean, every year you will increase by 2%. Okay. So it depends on. So when it comes to CPF management, you have to build your CPF well. You build your CPF well to be able to spend more in your retirement years.
Okay. But what if CPF Life doesn't give me enough income that I desire? Like you mentioned earlier, 1.3 to 1.7, right? What if I want more?
Yeah. So as a default, this is what you will get, FRS, free retirement sum. So if you want more, there are a few options. I mean, one of the straightforward options is that you can consider putting more money into your CPF. So instead of $213,000, you can transfer times 2, which is $426,000 into your RA account. And that will give you about $3,300 or so per month. Yeah. The trade-off of this is that even though CPF gives you very high payout, there's some trade-off. The trade-off is that you cannot liquidate the CPF. Okay, and
it's locked in.
It's locked in. Yes, until you die, until the person pass away. Because it's annuity plan. It's meant for lifetime payout. Okay, it's not meant to be surrendered halfway. But some people are very concerned about putting too much money in the CPF because they want to have that liquidity. And it could be because. And sometimes when a person is in their retirement years, they for example, need some liquidity. They need to cash out money, or if they suffer some medical conditions whereby they find that their life expectancy is shortened. Okay, they want to take the money and travel around the world. Okay, you can't do that in your CPF life. Okay, because money gets locked up. Another way to have the income stream would be is to consider retirement annuities or retirement income plans. Okay, retirement income plans are plans offered by insurance company. Works similar to a CPF life, whereby you need to put in capital, be it lump sum or regular premiums. All right, and then at certain point it can pay out. It can pay out income stream, whether is it for a number of years or for life.
I can choose.
Yes, you can choose. So it's more flexible. There are a few advantages to that. Firstly, unlike the CPF life, which only pays out from 65 onwards, okay, the retirement income plan actually allows you to earlier payout. For example, 60 years old or 62 years old, you can actually choose it to match your retirement age. All right, so that's one thing. Second thing is that because the duration can be shortened, all right, instead of spreading all the way to lifelong. By shortening it, the amount that you can pay out per year, per month or per year will be much higher than spreading out throughout. So that's number 2. Number 3 is that for retirement income plans, you can actually surrender. There's a surrender value. Certainly there will be some penalty to that, but unlike CPF life, you can surrender, especially when the person, for example, suffers a serious illness whereby he knows that he will not be living very long. He wants to use the money for something else. So retirement income has these benefits.
Okay, so now that I know the process, but it does not sound easy at all. What if someone needs help with securing their die must have retirement fund? What should they do?
The concept of retirement planning is actually not difficult to understand, but actually quite difficult to execute. All right, for people who needs help, you can actually write into us. We have a retirement service called the Core Assessment. Core stands for CPF-Optimised Retirement Essentials. Basically, it applies the 3 C's that we mentioned so far. We look into your CPF management. We look into generating a cash flow, especially for your essential expenses, which is your die must-have retirement. And thirdly, coverage, which is your medical safety net that you require for retirement. When there's a service inquiry, our insurance specialist will reach out to you to find out about your needs and then to gather information about what is your objectives or your requirements. And then after that, our insurance specialists will have a meeting, will schedule a meeting to go through the analysis to help you understand your retirement readiness and then propose solutions, how you can close the gaps so that you can secure retirement. At the end of the day, it's all about you and your needs, because at Haven, we are a safe place for people to seek advice without the fear of oversold, missold, and pressure sold.
So if you need to talk to someone about your retirement needs, please don't hesitate to reach out to Haven. And thank you so much for joining us on today's episode. We've come to the end. Please share, like, and comment down below if you do have any questions, and turn on the bell so you'll receive notification every time when we post. Thank you.
Bye. 3 C's.
3 C's.
The first C is
Coconut.
coconut. Do second one.
Okay, so by retirement, don't smile like this, Eddy, you make me want to laugh. Okay, so by retirement,
Why?
sorry, when he smile, his ear is shaking.
Huh? Okay, don't smile. Come.
No. Okay, so can I just know how does suddenly he smiled, I'm sorry.
There's a reason why I don't smile.